How much of your capital you should allocate to different asset classes is arguably one of the most important decisions you will ever make in your investing life. And while I'm a big believer in a very aggressive stock allocation, because historically stocks have outperformed all other asset classes, such as bonds, real estate, gold, or other commodities, I do believe that investors should at least consider allocating some capital to another asset class. And that asset class is cash. So what I want to discuss in this video is whether investors should always be fully invested or whether they should hold some cash in their portfolios. And if so, how much? I believe that truly understanding the role that cash plays in investors' portfolios, understanding the benefits and drawbacks of cash, is absolutely critical if you want to become a better investor. So without further ado, let's get started. Alright, hello fellow intelligent investors, my name is René Salman, and as I said, today I want to talk about the role that cash plays in investors' portfolios. Should investors hold any cash at all? Or if they should have some allocation to the most liquid asset out there, how much cash should investors hold in their portfolios? I would argue that there are two different schools of thought. One school of thought argues that the opportunity cost of holding cash is very high. And the other one stresses that the opportunity cost of illiquidity can be incredibly high too. And before I get into the weeds of this discussion, please let me know in the comments down below what you think. What role does cash play in your portfolio? Okay, so the first school of thought is that the opportunity cost of holding cash is incredibly high. So maybe to get started, we should first of all define the term opportunity cost. Generally in life, opportunity cost refers to the value of what you lose or are missing out on when you choose from two or more alternatives. And with respect to investing specifically, opportunity cost refers to the amount of money you might not earn by purchasing one asset instead of another one. Let me just quote Charlie Munger here to highlight why opportunity cost should always be at the top of investors' mind. He once said, "In the real world, you have to find something that you can understand, that's the best you have available. And once you've found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost." Proponents of being fully invested, those who believe that investors should have no allocation to cash, well, they will argue that cash is a drag on performance. Cash essentially delivers no returns, so this should not be your default option. Instead, members of this school of thought define the opportunity cost as the rate at which high quality, fast-growing businesses are growing intrinsically, are compounding their business value. And arguably, there are companies out there that can compound their business value at 20 to 30% annually for quite a prolonged period of time. So of course, there are costs of investing in cash. And one of the most fundamental costs of investing in cash is inflation. I'll just let Ray Dalio explain that cost to you, as he is known for being a long-time critic of cash as an investment vehicle.
The things about it as an investor at this stage is to understand, for example, the consequences of money printing. Okay, you don't get richer because of money printing. It produces inflation and it moves through the system to change asset prices in a certain way. So I explain how that works. And so, for example, you don't want cash. People think that the safest investment is to hold money in cash. It's the worst investment because you lose constantly to inflation. Something like 3, 4, 5% a year would be the tax, and your money will not be worth.
So there you have it. Inflation erodes the purchasing power of cash over time, and therefore cash is a terrible long-term investment. In the US, for example, the inflation rate rose to 7% quite recently, the highest since 1982. So again, there is a very real cost of owning cash. Right now, investors with large amounts of cash earn a return less than the rate of inflation actually. So they earn a negative real return. That's a horrible investment outcome. It's actually quite the opposite of what investors want to accomplish. For example, if you are sitting 100% in cash for 10 years, you are essentially destroying the real value of your net worth and not increasing it. What should actually be your goal as an investor. Currently, we are experiencing very low to sometimes negative nominal interest rates. So you don't earn any money on your cash if you hoard it in your savings account. And combined with inflation and the high inflation that we are seeing right now, that's the ideal scenario to actually erode the real value of your cash holding. So let's just assume inflation stays at 7% in 2022 and the cash in your savings account earns you, say, 0.5%. Well, then your real return will be negative 6.5%. Now, in addition to those negative real returns, having a large chunk of your net worth in cash also represents potential missed opportunities. That's the opportunity cost of cash that we have just talked about. So again, what return does an investor miss out on by not investing in other asset classes? Well, if you are a quality-oriented long-term investor, then your opportunity cost is the rate at which some of the best businesses in the world are compounding their business value. We've just talked about this. And if those world-class, fast-growing businesses can compound the intrinsic value at around 20 to 30%, and if you combine that with the negative real return of cash right now, then the opportunity cost of holding cash is getting very high very quickly. In investment speak, this is sometimes referred to as the performance drag of cash, or in short, just cash drag. The formula to calculate opportunity cost is opportunity cost equals foregone option minus chosen option. So if a business can compound its real value at 20% annually, and the real return of cash is, say, negative 5%, then the opportunity cost of going 100% in cash is 25%. In that video clip I showed you earlier, Ray Dalio highlighted that cash is often perceived to be a very safe investment, but it is actually the worst investment according to Dalio. Let me just show you another clip of Ray Dalio appearing on CNBC during the 2020 Davos World Economic Forum.
But also the question is, what do you jump into when you jump off the train? And the issue is you can't jump into cash. Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out.
So if cash is the worst performing asset class out there, if cash is trash, as Dalio has pointed out, what is the rationale for allocating a certain percentage of your portfolio to cash? Well, personally, I agree with Dalio. Cash is the worst asset class to be invested in over time. Only over time, that's true. But in the short term, cash also has something to offer, namely optionality. So while holding cash for a prolonged period of time in your investment portfolio is certainly not a wise idea. In the short term, cash can be an excellent asset class because it gives you options. As Matthew McLennan has stated, quote, "We don't feel the need to force cash to work just because it is a 0% yield today, because the return to cash has two components. It has current yield and it has the option of redeployment in distress." So that's the opposite school of thought. Proponents of having some exposure to cash would argue that the opportunity cost of illiquidity, so not having cash when you need it, is very high too. To get back to Ray Dalio here, basically Dalio said cash is trash right before the COVID March 2020 stock market meltdown. So with the benefit of hindsight, we can certainly conclude that Dalio was wrong. Cash was quite the opposite of trash in January 2020. Only 6 to 7, maybe 8 weeks later, having cash gave you the so-called dry power to load up the truck when many of the greatest businesses in the world were all of a sudden available at very attractive entry prices. And many of these high quality companies quite rarely trade at these attractive valuations. And similarly, cash gave you options when stocks plummeted in December 2018 after the great financial crisis in 2008. But also right now, while the S&P is trading close to its all-time high, many of the S&P constituents are actually trading at 52-week lows. Many fast-growing tech firms are down significantly and their stock charts look outright ugly. So sure, the nominal return of cash is basically 0%. But having cash to buy stocks when they can deliver returns of 30% plus annually over the next, say, 5 years. Because there is so much panic and irrationality in the market. Well, this also has its value. And that value is hard to quantify actually. It is called the option value of cash. And as this chart here shows, when prices decline very rapidly, the expected rate of return can increase just as quickly. Now, there is one caveat here. The way I just described it makes it seem easier than it actually is, I think. Because you will actually never know when exactly the market will drop 30, 40 or 50%. So there is a market timing element to it. Recessions seem to occur every decade or so in modern economies. So not very frequently. And maybe most importantly, they don't happen regularly. It's hard to predict when the next recession will happen. So as we all know, time in the market is way more valuable than timing in the market. Let me say that one more time. Time, not timing, is the key to building wealth in the stock market. Basically, when you go all in cash or simply increase your cash position quite significantly, if you do this too soon, say 4 years ahead of the next major market crash, you will miss out on gains that you can basically never recover. If you increase your cash allocation, say a few months or a year ahead of a market crash, that's amazing, and this can significantly boost your compounded annual returns. But is it really worth trying to time these dips? And maybe more importantly, can you do this consistently? At least mathematically, it doesn't seem to be the most optimal strategy. As the visual capitalist chart shows, perfect market timing, which just to be clear is impossible, does not add a lot to your compounded annual growth rate. So there is not too much upside here. But on the flip side, there is a much larger downside risk if you miss out on the best days the stock market provides. All right, I can imagine that you are a little confused now because there are arguments for both sides here. As I said, there are two schools of thought. So here's how I approach this dilemma or the discussion with the option value of cash on the one end of the spectrum and the performance track of cash on the other end of that spectrum. Well, one approach to determine how much money you should allocate to cash could be to have a certain hurdle rate. Say you are looking for investment opportunities that can return 15% annually. You would then use 15% as the discount rate in your discounted cash flow calculation and maybe even add a little margin of safety. And if you can find opportunities that pass this hurdle rate, awesome. You will seize these opportunities and be fully invested most of the time. If you're a competent investor and you know what you're doing and you can buy great businesses at attractive valuations, I think there is no reason why you should not put all of your cash to work. However, if you cannot find investments that pass your hurdle rate, well then your cash position will naturally grow over time. So it's not a conscious decision you're making here. You're not saying, I always want to have 15% in cash, but the lack of attractive opportunities will naturally lead to a higher allocation to cash. And obviously, if you increase your hurdle rate even further, say you want to demand an even higher margin of safety, then the chances of you building up cash would go up, as it simply gets harder to find investment opportunities that pass your hurdle rate. As Charlie Munger has said, it takes character to sit there with all that cash and do nothing. I didn't get to where I am by going after mediocre opportunities. Now, there is also a behavioral aspect to consider. Holding cash also offers many investors a behavioral or psychological advantage when stocks tank or drop quite sharply. Knowing that they can then scoop up great businesses at great prices helps them to stay calm during these drawdowns. But I think this topic deserves its own video. So that's it. And as always, may your finances and investments prosper. Good luck.